Hello and welcome back to the Financial Freedom Show. In this episode, we're going to take a look at my portfolio and some of the changes that I've done in the past couple weeks. And also, we're going to overview what VUG is and why I'm buying that index fund. So without further ado, if you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with my latest portfolio changes. And comment down below what you're adding to your portfolio. What are you buying and what are you investing in? So as you can see, over the past couple weeks, my portfolio has gone up quite a bit. I deposited about $1,500 into this portfolio over the past couple weeks into my Roth IRA. As you can see, my portfolio grew from about $24,000 to a total of $26,160. And today's gain/loss was about $109, but that is because the market went down today. I continue to invest in this portfolio, and I'll continue to add to my positions as the market drops. If the market goes down, I'll continue to add even more aggressively in the next couple of weeks or months. If we take a look at my positions, I actually added the money into my Roth IRA, bringing my account total up to $10,175.71. And that $1,870 went into the FTech fund, which is the Fidelity MSCI Information Technology Index. So basically that fund is a bunch of tech companies, and it's a very aggressive growth fund. Most of the holdings are in Apple and Microsoft, but we'll cover that in a later video. In today's video, we're going to discuss what the majority of my allocation in this fund is in, which is VUG, which is the Vanguard Index Fund. Basically, it's a growth fund. As you can see, I have $8,305 in VUG with an average cost of $302.10. My average cost is actually a lot lower than that. It was about $250 or so, but I sold out of this fund and bought back in whenever I bought my house. But it kind of increased the average cost. As you can see, I have 26 shares. If we go to the dividend view, you can see that I currently am making $48 a year in dividends from this fund. And from FTech, I'm making $14.54 for a total of $62.66 for each year in dividends in my Roth IRA. And in my normal account, I have SPLG, which is making me $160.05 per year in dividends. And I also hold SPAXX, which is my security fund. It's basically my safety net. It is almost $5,000, and it's making me about a little under $300 a year on average in dividends at a 5% yield. So that is basically an overview of my portfolio. If we take a closer look at what VUG is a large growth fund. It's an index fund from Vanguard. Basically, it's focused on tech stocks, which are expected to grow over the next couple of years at a higher rate than the rest of the market. That is why it is a growth index fund. It's more growth focused. If we take a look at the expense ratio, it's really low at 0.04%. That is really good for an index fund, for a growth fund. Right now, the current market value is $310.74 per share. If we take a look at the performance so far this year, it's down 0.08%, but that's only like 2 weeks worth of performance, so that's not very representative of this fund. If we go down further, we can see what this fund has averaged over time. You can see that it has averaged about 10.75% since inception in 2004, which is excellent performance. In 2023, it went up 46.85%. In the past 3 years, it was only 7.7%. In the past 5 years, it was 19.18%. And in the last 10 years, it was 13.98%. So this fund typically outperforms the S&P 500 in years that the market is going up. So that is one of the reasons why I want to own this fund, is because I want to see the upside of growth funds. Because I'm so far from retirement, I believe I should focus on growth instead of dividend funds. That is one of the reasons I invest in VUG, mainly in my Roth IRA portfolio. because I can't touch that money until I'm 59 and a half. And that is something that I'm focusing on, is just building that nest egg for when I retire. So the VUG fund seeks to track the performance of the CRSP US Large Cap Growth Index Fund. It provides a convenient way to match the performance of many of the nation's largest growth stocks, and it follows a passively managed full replication approach, which means with respect to its 75% of its total assets, the fund may not, 1, purchase more than 10% of the outstanding voting securities of any one issuer, or 2, purchase securities of any issuer if, as a result, more than 5% of the fund's total assets would be invested in that issuer's securities, except as may be necessary to approximate the composition of its target index. As I said before, the fund was created in 2004, so it has a little bit of history to it. It has been through the crash in 2008, and it stayed relatively flat for those years, but over the past 10 years or so, the fund has just ripped to the upside. So something to take into account is that in the future, it could have flat to negative returns for the next couple of years. But in the long run, I believe this fund will outperform the S&P 500 and continue to grow over time. So that's one of the reasons why it's in my portfolio. As you can see, over the past 10 years, it has gone up. From 2014, it was at a share price of about $90.21, and it went up to about a peak of $320.83 in 2021. Then the market dipped in 2022, and this was when I was aggressively buying this fund when it dipped. I got some shares that were around the $213 mark at the bottom, but I've been dollar cost averaging into this fund ever since it dropped. And it went back up, and I gained about $6,000 in my Roth IRA before I bought my house in this fund. And it reached a share price of $310.82. So it's on its way to make all-time highs potentially in the near future, but nobody knows what's going to happen in the market. It could go back down to where it was at before, which honestly I would rather prefer, because then I can pick up more shares at a discounted price than before, and it will also consolidate there for a little bit and allow me to accumulate more at the lower cost. But nobody can predict the future. It could go straight up from here. It could drop down below where it was at in 2020. Nobody knows what's going to happen. I'm just going to continue to dollar cost average into this fund. Currently, you can see that they hold 208 stocks, with the benchmark holding 207. They have a median market cap of $789 billion. The earnings growth rate is 20%, which is crazy. The PE ratio is a little bit on the high side of 37.2%, which is why I believe it might come back down in the short term, just to even that PE ratio out a little bit. It's kind of high right now with the AI bubble that's going on, I believe. But nobody knows the future. It could continue to go up from here, but we'll see what happens. You can see that their turnover ratio is 5.4%, which is good. That's kind of low, on the lower side. We don't want to see like a 50% turnover ratio, because that means they're selling out of stocks and buying into new ones. So a lower turnover ratio is really good, because it means they're holding onto those stocks. The return on equity is 33.6%, which is really good. And the fund's total net assets is $200 billion under management, which is kind of high for an index fund that's not based on the S&P 500, which is good to see. If we go down to their weighted exposures, you can see that technology is their largest exposure in this fund. It's currently 54.8% of the fund, so more than half of the fund is in technology stocks. And I think that's one of the reasons it'll outperform in the future. As technology continues to improve, we'll see more returns in that sector. And that sector has continued to become a larger part of the S&P 500. Over the past couple of years, it's gone from being in line with the rest of the company's earnings to almost being double the earnings of other companies in other sectors. So technology is definitely the most profitable sector in the S&P 500, and I believe it'll continue to become more profitable as more technology is released, more AI, more certain things are going to continue to improve margins. It's one of the lowest margin sectors because a lot of it's online and subscription based. So definitely going to see more growth in the technology field, I believe. That is why I believe this is a good fund to hold in your Roth IRA for the long term. But obviously do your own research. You can also see that basic materials consists of 1.4% of the fund. Consumer staples is 0.7% of the fund. Energy is 1.3%. Financials is 2.6%. Healthcare is 7.1%. Industrials is 8.90%. Real estate is 1.8%. Telecommunications is 0.90%. And utilities is 0.20%. So you have all the different sectors in here. They're just way smaller holdings than technology. Technology is the largest holding in this fund. If you go down to holding details, you can see that obviously Apple and Microsoft make up the two largest percentages of the fund at 12.99% and 12.76%. Both of these are the largest holdings in this fund. The next largest holding is Amazon at 6.45%. Nvidia is the fourth largest holding at 5.3%. Google is the next largest holding at 3.7%, but this is actually skewed because it holds Alphabet Class A and Class C shares. So actually the weighting of Google in this fund is close to 6.9%, making it higher than Amazon. So really the top three holdings in this fund are Apple, Microsoft, and Google. If we continue to go down, you'll see that Facebook makes up 3.59% of this fund. Tesla makes up 3.07%. Eli Lilly makes up 2.27%. And Visa makes up 1.82%. These are all really great companies, and I believe they'll continue to outperform in the future. I'm a little iffy on Nvidia just because of how high it's gone in the past couple years, but you never know what's going to happen in the market. It could continue to go up over the next couple years, and you just never know. Nobody knows what's going to happen. If we go down to their distributions, you can see that they have a quarterly distribution schedule. It's kind of similar to the S&P 500. The last dividend was on December 27th of 2023. And it was a distribution of 58 cents per share. As you can see, the dividend continues to improve over time. It's going to continue to increase in the future. This is kind of a short-term view here of only a year or so, but you can see that the dividend actually went up over the past 2 years. It's increased. So definitely lots of dividend growth in this fund, but also price appreciation, I believe. So hope you guys enjoyed this video. If you did, be sure to give it a like and subscribe in order to stay up to date with the latest in my portfolio's changes. I'll continue to be completely transparent and show you guys what I'm buying in my portfolio, what changes I make, what funds I add, and I'll continue to explain to you guys what my thought process is, and hopefully you guys enjoy. Leave a comment down below what you're doing in your portfolio. I love to read the comments. And I'll see you guys next time.